In this episode number 17 of EO Radio Show, I cover some federal Internal Revenue Code rules that charitable organizations and their donors need to know in order to make sure that the donors benefit from the charitable contribution deduction for their contributions. After a brief overview of the landscape of contribution deduction rules, there are many, I will be talking with Sarah Vandeweerdt, who is the co-head of the Trust, Estates, and Appraisals group at Christie's. She'll talk to us about appraisals of art and collectibles and is joining us from Rockefeller Center in New York City. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. So let's start today with basic requirements that apply to charitable organizations that accept contributions for which the donor expects to be able to deduct all or a portion of the gift from their U.S., federal, and state income taxes. Under the Internal Revenue Code, there are special rules for three categories of gifts: gifts of cash, gifts where the donor receives something in return, and gifts of appreciated assets. Now, there are a lot of intricate rules about whether the donor is entitled to a charitable contribution deduction, and I'm not going to go into all those details here. Instead, what I'm going to talk about most is what the charity's obligations are to support the donor who may be entitled to a deduction. First, let's talk a little bit about the charity's obligations relating to gifts of cash. The donor who wants to take a contribution deduction must obtain and keep a bank record or a written communication from the donee as a record of the contribution of any size. There are additional requirements as we leveling up to gifts over $250, gifts over $500, then $5,000, then $50,000, and then the final level of our game here, those gifts over $500,000. For these larger contributions, the donor needs to obtain and keep a contemporaneous written acknowledgement for a charitable contribution. This means that the written acknowledgement must generally be obtained by the donor no later than the date the donor files the return for the year the contribution was made. This written acknowledgement must state whether the donee provides any goods or services in consideration for the contribution. For more information on contribution deduction requirements, take a look at Publication 1771 from the Internal Revenue Service. And by the way, there are a lot of show notes this week with links to a lot of resources for charitable contribution substantiation. So the second set of rules to talk about today are those that apply to quid pro quo donations. That is, where the charity gives the donor something in return for the gift. A charitable organization must provide a written disclosure statement to donors of a quid pro quo contribution that exceeds $75 in value. This applies to any contribution where a payment is made to a charity by a donor partly as a contribution and partly for goods or services provided to the donor by the charity. The required written disclosure statement must cover two essential items. Number one, that the amount of the contribution that is deductible for income tax purposes is limited to the excess of any money and the value of any property other than money that was contributed by the donor, the excess that is over the value of goods or services provided by the charity. And second, the written disclosure must provide the donor with a good faith estimate of the value of the goods or services that the donor received. There are a few exceptions to note for insubstantial value of the quid pro quo, and that insubstantial value is determined under IRS rules. There are also exceptions when there's no donative element involved at all, that is, a purchase from a museum gift shop, or in the case where there's only an intangible religious benefit provided to the donor. The third topic, and our main topic for discussion today, will be around the rules that apply to contributions of property other than cash. Generally speaking, the amount of a donor's charitable contribution for a gift of property other than cash may be as much as the fair market value of the property at the time of the contribution. Sometimes, though, the deduction is limited to the basis, but again, that's a separate topic. Today, we are staying focused on how the charitable organization supports its donors when substantiating gifts of property. There are a whole host of special rules, by the way, that apply to contributions of clothing and household items, vehicles like a car, boat, or airplane, taxidermy property, property subject to debt, partial interests in property, fractional interest in tangible personal property, conservation easements, future interest in tangible personal property, inventory from a business, patents and other intellectual properties. We're not going to talk about all those. Those are much too detailed for a podcast, I think. So anyway, now we get to the fun part of today's episode. That is the general guidelines for determining the fair market value of donated long-term capital assets. IRS Publication 561, also linked in the show notes, contains a much more complete discussion of these topics. As I alluded to at the beginning, the amount of detail required of the taxpayer when reporting to the IRS depends on the value of the non-cash contribution, and the amount of detail builds as we go up the levels. Everything at the lower level, that is, all of the requirements for substantiation at the lower levels are included, plus there are more details required each time we level up. So, recapping, for a non-cash contribution, that is a contribution of property of a value of less than $250, with some exception, the donor needs to keep a receipt from the charity showing the name and address of the charity, the date and location of the contribution, and a description of the property in sufficient detail under the circumstances, taking into account the value of the property, for a person not generally familiar with the type of property to understand that the description is of the contributed property. So those are the basic requirements for non-cash contributions of less than $250, and they'll apply for all of the following levels, plus there's more. So at the next level up, for a donation value of at least $250 but not more than $500, the donor must get and keep a contemporaneous written acknowledgement from the charity with the same requirements as discussed a few minutes ago. But it has to be a contemporaneous acknowledgement, and it has to be from the charity itself. Level up again. For deductions over $500 but not over $5,000, we add to all of the foregoing the exciting IRS Form 8283. This Form 8283 is attached to the donor's federal income tax return for the year of the donation and must include all of the information described above and additional details. Again, that includes the description of the property with sufficient detail, like we talked about for the smaller value gifts, a statement of the fair market value of the property on the contribution date, and the method used in figuring out the fair market value. In the case of a gift of real or tangible property, a statement as to its condition. In the case of tangible personal property, a statement as to whether the charity has certified it for a use related to the purpose or function of the charity. In the case of securities, the name of the issuer, type of securities, and whether they were publicly traded on the date of the contribution, and then other information about how and when the donor acquired the property and its cost or adjusted tax basis. Okay, now we're going to level up again. When the donor's contribution amount goes up to the next level, a deduction of over $5,000, in addition to everything just described, the donor must also obtain a qualified written appraisal of the donated property from a qualified appraiser, and those appraiser must complete the Form 8283 along with the donor. So a lot more detail here. This is the fun part. The Form 8283 must be signed by both the charity that received the contribution, the qualified appraiser, and of course the taxpayer. So now we're getting to some serious third-party confirmation of the deduction claim, with everyone signing under penalty of perjury in a form that's attached to the donor's tax return. So let's talk a little bit more about these details. A qualified appraisal is defined in the Internal Revenue Code. That is an appraisal document that meets the following criteria. First, a qualified appraisal is an appraisal document that is made, signed, and dated by a qualified appraiser in accordance with generally accepted appraisal standards. It meets the relevant technical requirements of Treasury regulations. The appraisal has a valuation effective date no earlier than 60 days before the date of the contribution and no later than the date of the contribution. For an appraisal report dated on or after the date of the contribution, the valuation effective date has to be the date of the contribution. And finally, the qualified appraisal must not involve a prohibited appraisal fee. Finally, there's one more level up. With only a few exceptions, for a deduction of more than $500,000 for a contribution of property, The donor must also attach the qualified appraisal prepared by the qualified appraiser to the tax return. So the appraisal itself is going to the IRS along with the tax return. So with all that background, I'm delighted to introduce Sarah Vandeweerdt. Sarah is co-head of Christie's Trusts, Estates, and Appraisals Department and the director, president, and chairman of Christie's Appraisals, Inc. In this role, Sarah oversees and drives strategy for Christie's appraisal services in the Americas. With over 25 years in the field, Sarah has been instrumental in the successful appraisal and sale of several important estates at Christie's, including the Peggy and David Rockefeller collection, which in 2018 was the highest auction sale total for a single owner sale and the most significant charity auction ever staged. Sarah received her bachelor's degree in art history at the Catholic University of America in Washington, D.C., and she has a master's degree in fine and decorative arts from the Sotheby's Institute of Art in London. She has successfully completed the coursework and examination for USPAP, that stands for Uniform Standards of Professional Appraisal Practice, and she is a friend of the Appraisers Association of America. Thanks for joining me, Sarah, and thanks for listening to all that dry tax geek stuff. I'm really excited to apply these dry rules to contributions of collectibles and works of art. Before we get to that, though, tell us a little bit about your background. How did you come to work in appraisal services?
Thank you, Cynthia. It's such a pleasure to chat with you today. I've always had a passion for fine art, decorative arts, French furniture in particular. After studying art history as an undergraduate student, I was fortunate to secure an entry-level role at a family-run auction house, and I was immediately hooked. I started out handling appraisal inquiries. It was letters containing physical photographs at the time, and my interest in appraisal services and how we can assist collectors grew from there. My graduate degree program included practical experience. We had physical handling sessions with furniture, silver, and porcelain, so you could develop a vocabulary for how to describe a work of art. We were in London, and we had access to museums and the National Trust houses, which we toured with our instructors. And when I returned to New York and joined Christie's, it was just a wonderful merger of my interest in art with a client management role in which we help clients with the stewardship of their collection through the appraisal services we provide. I'm really fortunate to partner with specialists who have exceptional expertise in their respective fields, everything from fine art to wine.
Wow, wine bottles too. That's funny because actually a lot of wine bottles have a lot of wine branding revolves around the art in their label. But your mention of looking at letters with photographs, not many people know that in my undergraduate time, I worked for a short time at the art museum at my university, and my job was to type out 6 provenance cards for each item contributed to the museum or purchased by the museum. But I used a typewriter, and I would look at the Christie's and the Sotheby's catalogs to get the date and refer to that. And I've been hooked on art ever since as well. My career obviously went a really different direction. But and wow, fast forward 3 or 4 decades from looking at photos and typing to what an appraiser does today. It's just amazing to me and a lot of fun to think about. So let's take apart the rule for determining fair market value. That's a phrase we say so often, but which for appraisers and particularly for the IRS, it carries a lot of nuance. Fair market value is very different than a lot of things like replacement cost and other terms for value. Tell us a little bit about the nuances of fair market value when appraised, when we're doing a fair market value appraisal.
Certainly. First, I want to mention that the IRS recognizes only one definition of fair market value, whether it's for charitable contributions or estate and gift tax purposes. In short, fair market value is defined as the price at which property would change hands between a willing buyer and a willing seller, neither having to buy or sell, and both having reasonable knowledge of all the relevant facts. So, in layman's terms, an art appraiser thinks about what that work of art would sell for in the appropriate sale venue. Is it auction? Is it retail? Is it a gallery? Given everyone is a willing participant, and the buyer has had an opportunity to know what they're purchasing. We often say that valuing art is not a science. Unlike other assets such as stock or securities, you can't look up and see what Picasso's trading for during a specific point in time. The most common approach to determining fair market value for a work of art is the sales comparison approach. An art appraisal will look to sales of similar works. But as you pointed out, Cynthia, there are nuances to that evaluation, and there are many factors to consider in the process. For instance, if you're looking at comparable sales at auction, you must consider the buyer's premium. In the auction context, the IRS views fair market value as the hammer, plus the buyer's premium. So the hammer is the price when the gavel falls in the sale room, such as sold to the lady in blue for $1 million. But it's the hammer plus the buyer's premium, which is the commission the purchaser pays on top of that final bid price at auction. That's what the IRS considers fair market value.
I hadn't realized that. But wait, there's more.
Well, buyer's premium can vary from auction house to auction house, and it can be as high as 26%. But so when an appraiser looks at auction results, it's very important that they ensure that they're taking the buyer's premium into consideration.
So let's talk a little bit about different kinds of property also and what the appraisal standards might be. I mean, does it vary property by property? Are the standards the same for wine, say, as jewelry?
The standards don't vary from collecting category to collecting category. A credible appraiser will see the work in person, will inspect it for condition, will research the market comparables, and come to their conclusion. But there are a number of nuances and factors to take into consideration when comparing and contrasting the merits of the work in the appraisal to the comparable sales. Understanding what makes one work more desirable than another is key. For instance, why is a red or pink Rothko more valuable than a green one? Or why is one wine producer more sought after than another? And there's provenance to consider. Who previously owned the work? Was it part of a notable collection, such as Peggy and David Rockefeller? At Christie's, we saw a huge uptick in the prices realized given the notable provenance of the items collected by the couple. Also, something to take in consideration, has the work ever been exhibited or published? We have appraised works that have appeared on the cover of significant publications for an artist, which is an important distinction. And a savvy appraiser is also going to consider who are the active buyers for this type of work and what is the current state of the market. We certainly see shifts and swings in the marketplace, and a knowledgeable appraiser is going to really think about the current appetite in the market, given both the individual merits of the work and the context of the comparables. I have a good example of that recently. Christie's in May 2022, we offered a work by an American 20th century artist named Ernie Barnes. Very well-established 20th century artist, figurative painter. Previously, his record at auction was $550,000. So in May, his work Sugar Shack sold for $15,275,000, with it, and the work had an estimate of $150,000 to $200,000. And that sales result really reflected there's strong interest currently in artists of color, and it really spoke to the cultural significance of the subject matter depicted.
So it really depends. There's a lot of timing involved, or I should say timing really matters in the appraisal. As I mentioned a little bit ago, the qualified appraisal for tax purposes can't be more than 60 days before the date of the gift, but it can't be later than the actual date of the gift. So for that artist, if you were appraising something the day before the $15 million sale, you're only going to look at as an appraisal what the state of the world was the day of the gift.
Exactly, the day of the gift. Fortunately, you can produce an appraisal after the date of donation, as long as you explicitly state on the appraisal that the valuation date is as of the exact day, month, and year of the donation.
One other thing that I think appraisers look at, and that is condition. I think for something that's very old, in doing your appraisal, you compare it to other things of the same age. Your comparables would be limited to those, and so valuation would follow the condition. This might be a little garbled, but thoughts about how condition plays into the appraisal process.
When you're evaluating a 20th century painting, the standards for something in good condition will certainly be different from a 12th or 13th century antiquity. So an appraiser looks for what a typical condition would be given the general use, wear, age, and what they commonly come across.
And then they'll compare that to other sales of similar condition of that particular, maybe not artist if it's an antiquity, but of that typical genre or class of asset or class of art. So let's move on a little bit and talk about what makes a qualified appraiser. These two terms, qualified appraisal and qualified appraiser, are key to the tax deduction. Tell us what it means to be a qualified appraiser.
So when engaging an appraiser to provide a charitable donation for an artwork, it is critical that the collectors work with an appraiser who meets the current IRS qualifications. And as you know, Cynthia, the IRS issued new regulations for the substantiation of charitable contributions, which went into effect on January 1st, 2019. And there were some notable changes in the regulations, including a revised definition for a qualified appraiser. Currently, a qualified appraiser is an individual with verifiable education and experience in valuing the type of property for which the appraisal is performed. But previously, the regulations stipulated that an individual had verifiable education or experience in evaluating the type of property being appraised. And that conjunction is significant.
So it's both now.
It's both now.
Both education and experience.
Exactly. So per the IRS, that individual can meet those qualifications by earning an appraisal designation from a generally recognized professional appraiser organization. In other words, they have credentials from one of several reputable organizations, such as the Appraisers Association of America, the AAA, or the International Society of Appraisers, the ISA. Both organizations have rigorous admission requirements, which are outlined on their websites. And you can also find appraisers in many collecting categories on their websites. Both have very, very helpful resources.
Any other requirements for a qualified appraiser or exclusions?
Absolutely. There are definitely exclusions that you should be mindful of. Some are obvious, but they're all pretty logical. An appraiser can't be the donor or the donee. They also cannot be a party to the acquisition in which the work was acquired. I get that question often. In other words, if you purchase the work of art via the appraiser, they are automatically disqualified from providing the appraisal. For example, if you purchase a work at Christie's and you later donate it to a museum, you should not engage Christie's for the appraisal. IRS wants an arm's length service. They want an independent, unbiased opinion of the fair market value.
Well, speaking of the IRS, let's talk a little bit about the IRS's view of a claimed value of artwork. When does the IRS really scrutinize this 8283?
So if a taxpayer's return is selected for an audit and it includes an art appraisal with individual works valued at $50,000 and higher, it's automatically referred to the Art Appraisal Services Division of the IRS, known as the AAS. The AAS staff appraisers first conduct their own research, consulting auction sale databases for comparable sales, and they may also consult galleries to fact check.
So are these specialists at the IRS that have an art background, or is this just your random IRS agent?
No, they're agents who have art backgrounds.
Oh, okay.
Who have that specific role within the branch of the IRS. So for higher value works, generally those with an individual fair market value of $150,000 and above, the AAS staff appraiser typically consults with something called the Art Advisory Panel. And the panel comprises roughly 20 to 25 art professionals, such as major dealers and museum professionals, who have many years of experience in their respective fields. The panel assists the IRS by reviewing and evaluating property appraisals submitted by taxpayers in support of the fair market value claimed in works of art. The panel is voluntary and they do not receive compensation.
I guess this is a civic duty sort of reason why people would be on the art advisory panel. I guess another question is, are their names publicly known, or is this a secretive group or an anonymous group?
Their names are publicly known, and the IRS publishes a list of the current art panel members on their website.
And I am guessing they're across all the genres. Could there be a bottle of wine that's worth $150 that's donated? I don't know, but they must be different specialties, right?
I haven't seen a wine specialist on the panel, but yes, there is a range from American art to old masters to furniture to Chinese works of art. And the IRS does reach out to outside specialists if needed.
Oh, okay. This has been great. This is really interesting. Before we wrap up, do you have any parting thoughts, any points you wanted to make sure that the audience keeps in mind as they think about appraising and donating their works of art?
One little tip I wanted to mention is that the 8283 form that you mentioned previously, Cynthia, make sure you're using the most current form. IRS often updates that document, and you want to make sure you're using the most recent one, which you can find on www.irs.gov. And just encourage collectors to be thoughtful when engaging an art appraiser. You want to make sure that they meet the current qualifications and that you want to make sure that you meet the current qualifications.
Yeah, absolutely. That's really good advice. And on the search for IRS documents, if you just Google IRS Form 8283, you may get links to different IRS forms, but go to the irs.gov site and they'll have the most recent one there. There's often not a lot of great things said about the IRS, but their website really is quite good. And so there are a lot of links in the show notes to resources at the IRS and other resources. Sarah, tell us about how people can learn more. Do you have any resources that we'll add to the show notes?
Absolutely. If anyone has general inquiries that Christie's can be helpful with, don't hesitate to reach out to us at info@christies.com or by phone at 212-636-2000.
Thank you so much. I am so glad you were able to join me today. I love talking about art much more than I like talking about taxes. It's been great having you here.
Thank you so much, Cynthia. It was a sincere pleasure.
This has been great. So that's all for this episode. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.